In the stock market, the head and shoulders pattern is considered one of the most popular reversal chart patterns. Because this pattern is well known, many beginner traders often make mistakes when trading it. In today's video, while learning about the head and shoulders pattern, we will focus on 4 main points. Number 1, what the head and shoulders pattern is and how to recognize it. Number 2, where to take the entry. Number 3, where to place the stop loss, and number 4, how to set the profit target. Let's get started, but before we dive into the video, make sure to hit the like button, and if you're new, don't forget to subscribe to our channel and turn on the notification bell so you never miss our latest uploads. I'll see you right after the intro and disclaimer. First of all, we will understand how the head and shoulders pattern works. This pattern is made up of 4 key parts. First, the left shoulder, then the head, followed by the right shoulder, and finally, the neckline. When combined, these 4 components form the complete structure of this pattern. At first glance, it may look very simple on the chart. In this example, the price is moving in an uptrend. No matter what the market trend is, the price never moves upward in a perfectly straight line. For the uptrend to continue, the price must advance by forming a series of higher lows. Here on the chart, after the price makes an upward move, sellers step in at the higher levels, pulling the price down. However, because there aren't many sellers, small candles appear on the chart, showing that the price is consolidating gradually within a tight range before moving slightly lower. At these lower levels, buyers once again enter the market to maintain their dominance. As a result, the price breaks the previous high and creates a new high. But due to strong selling pressure at the upper levels, the price once again declines, returning to its previous swing low. At this point, a clear support area is formed, which we call the neckline. The price then attempts to move up again, taking rejection from this support area. However, because there are fewer buyers this time, the price cannot sustain at this level for long. Sellers step back in with full control, pushing the price down toward the neckline once again. This becomes the final attempt by buyers to push the market higher. For all the buyers currently holding positions, this neckline serves as the last crucial support area. If the price falls below this level, those buyers will begin to panic and start closing their positions. As soon as the neckline breaks, heavy panic selling occurs. All buyers who placed their stop losses near the neckline will have their stops triggered, which causes the price to drop sharply, resulting in a strong downward move. This entire price action forms the head and shoulders pattern on the chart. When viewed, this setup represents a perfect reversal trade opportunity. However, keep in mind that not every head and shoulders pattern is reliable for trading, so proper confirmation is always necessary before entering a trade. Before trading any chart pattern, it is very important to first understand the overall market structure. If the market is in a strong uptrend, simply spotting a head and shoulders pattern on the chart is not enough to enter a reversal trade. During a strong uptrend, the price may just take a small pullback and then continue moving upward again. In such a case, your trade entry will fail, and you will end up facing losses. Therefore, before taking a trade entry in the head and shoulders pattern, there are a few key points you must keep in mind. Number 1, if, in the head and shoulders pattern, the right shoulder is significantly bigger than the head, you should avoid entering a trade. This indicates that buyers in the market have once again managed to show their strength. As a result, sellers may feel pressured to exit their positions out of fear that their stop losses will be triggered. This increases the chances of a failed trade entry. Number 2, if the right shoulder takes too long to form, you should also avoid trading. When the price takes too much time to reach the neckline, many sellers in the market will have already built up the positions. As soon as the price finally approaches the neckline, these sellers may exit their trades, causing an increase in buying pressure. This sudden buying activity can push the price upward, leading to the failure of the head and shoulders pattern. Number 3, if the height of the right shoulder is more than 50% of the height of the head, this trading setup is generally considered unreliable and likely to fail. By keeping these important factors in mind, let's now discuss how you can make a proper trade entry in the head and shoulders pattern. The head and shoulders pattern is primarily used as a reversal trading setup. So, if the market is in an uptrend, you can take a short trade after the breakdown of the neckline. However, this type of entry is considered an aggressive trade entry. If you want a safer trade entry, you should wait for the price to retest the support area after the breakdown. This is the most accurate and effective way to enter a trade because it helps you avoid getting trapped in false breakouts. But many times, the breakdown happens so quickly that you don't get a chance to enter the trade. In such situations, you should avoid chasing the price and patiently wait for a pullback. If the price fails to pull back, it's best to completely drop the idea of entering that particular trade. After understanding the proper method of trade entry, now let's discuss stop-loss placement. When trading the head and shoulders pattern, your stop-loss should be positioned in such a way that if the market moves to that level, it clearly indicates that your trade setup has failed. This means your stop-loss should be placed slightly above the previous swing low. If you fail to do this, normal market volatility could easily trigger your stop-loss, forcing you out of the trade prematurely. For those making an aggressive trade entry, the stop-loss must be placed above the high of the right shoulder of the pattern. This placement helps protect you from stop-loss hunting and keeps your trade more secure. Now, let's understand how to set a profit target. In the head and shoulders pattern, there are two main methods you can use. Number 1 is the price projection method, also known as the fixed target method, and number 2 is the trailing stop-loss method. In the first method, to determine how far the price can move after the breakout, measure the distance from the high of the head to the neckline. Once you have this distance, set your profit target at the same distance from your entry point. This is known as the price projection method. However, the drawback of this approach is that since your profit target is fixed, your overall profit becomes limited. No one can accurately predict how long the market trend will continue after your trade entry. To capture the entire trend movement, you can use the trailing stop-loss method, which allows you to maximize your profit. By applying a trailing stop-loss, you can lock in your gains by booking partial profits while still staying in the trade as long as the market moves in your favor. That's it, traders. Thanks for watching this video. Every major journey begins with a single step, and today you've moved one step further. If this video brought value to your learning, don't forget to hit the like button, it really makes a difference. And if you're visiting for the first time, subscribe and be part of a community dedicated to learning, growth, and success together. Thanks for watching, and I'll catch you in the next video.